Hello and welcome. Before we start, please make sure to subscribe to our YouTube channel for news and updates. With markets nervous about stubborn inflation, a gradually slowing labor market, and the timing of the first Fed rate cut, investors are more focused on this corporate earnings season than usual. With 92% of S&P 500 companies having reported their first quarter earnings results, the trends are positive. Blended earnings growth is coming in around 5.4% year over year, the highest in almost 2 years, making this the third straight quarter of earnings growth. The S&P 500 is now only about half of 1% below its all-time high. Earnings growth supports the stock market over time. While investors focus a great deal on topics such as inflation, the job market, and GDP, investors do not directly invest in the economy. The accompanying chart shows that while they do not mirror each other exactly, there is a strong relationship between corporate earnings and the stock market. The stock market tends to follow the trajectory of earnings, with differences between the two lines the result of changes in stock market valuations and investor sentiment. This is why economic cycles matter for long-term investing. When the economy is growing and consumers are strong, company sales tend to improve. Conversely, spending tends to slow during economic downturns, hurting corporate profits. For investors, focusing on these longer-run trends is far more important than trying to guess what the market might do over a day, week, or month. Earnings growth reached an inflection point last year. As the accompanying chart shows, the growth of corporate profits reached an inflection point last year and has begun accelerating again after struggling in 2022. While the economy avoided a recession that year, the stock market did enter a bear market partly because there was an earnings recession among large-cap companies. Stock market prices have risen significantly over the past 18 months. The current S&P 500 price-to-earnings ratio is just under 20 times next 12-month earnings, partly due to the strong bull market rally pushing up the numerator, and partly because earnings growth is only now supporting the denominator. So if earnings growth does continue to accelerate, valuation measures such as the price-to-earnings ratio could improve. Economic fundamentals remain strong. Concerns over a recession or hard landing have moderated in recent quarters. Fed funds futures, for instance, are now anticipating mild rate cuts this year compared to the start of this year when many investors expected the Fed to cut rates rapidly in response to a possible recession. Additionally, data from the Federal Reserve Bank of Richmond's CFO survey echoes this sentiment. Optimism about the economy reached its highest level since the second quarter of 2021. Estimates by chief financial officers for real GDP growth for the next year averaged 2.2%, up from 1.7% at the end of 2023. Only 10.1% of CFOs believe that a recession will occur over the next year. The bottom line? The latest earnings figures show that companies are performing well, which is a positive sign in this uncertain market environment. In the long run, investors should focus more on trends around economic fundamentals such as earnings than on day-to-day stock moves. Thank you for listening. For additional information, please visit mraadvisory.com.